You probably picture trading as a high-stress, everyday grind, staring at glowing screens and chasing every minor price fluctuation. But the most sophisticated participants approach the market with a different rhythm. They wait all year for a single, massive opportunity. The arena for this level of patience is the U.S. bond market, specifically the 30-year Treasury. Because this asset class is driven by heavy institutional capital, its trends are historically robust and often span several months. Consider the possibility that the most significant move of the year isn't a random event, but a statistically predictable cycle linked to a specific window on the calendar. Real proficiency in these markets isn't found in constant activity. It requires the discipline to remain inactive until the statistical odds shift heavily in your favor. Decades of historical data reveal a repeating phenomenon in U.S. bonds. The market typically experiences weakness in the early months of the year, trading down to form a significant seasonal low between May and June. This calendar tracks that annual cycle. The dip occurring in May and June serves as the starting point for a powerful rally that regularly carries price higher through the late summer and into the autumn months. However, a seasonal tendency is a statistical edge, not a certainty. Simply buying because the calendar says May is a reliable way to lose capital. The calendar identifies the window, but a professional entry requires physical evidence on the charts that institutional smart money has begun accumulating positions. To identify those institutional movements, we analyze three tightly linked assets simultaneously: the 5-year, 10-year, and 30-year Treasury notes. Under normal conditions, these three bond maturities move in harmony. This diagram shows how their yields typically stay in perfect lockstep across the different time horizons. Major financial institutions operate with immense volume. When they step into the market to quietly accumulate positions, the sheer magnitude of their orders disrupts the standard physics of the market. Because they spread these massive orders across different maturities to manage risk, their buying pressure creates a localized footprint, temporarily cracking the perfect correlation between the bonds. Monitoring this breakdown in correlation provides the data needed to verify that the seasonal low is actually taking shape. This specific anomaly is known as SMT divergence, the technical signal that a high probability reversal is underway. Watch the 5-year bond on this chart. As price moves down during the seasonal window, it pushes lower to create a new definitive valley on the graph. At the same moment, look at the 10-year and 30-year bonds. They fail to reach that new low, instead forming a higher valley or remaining flat despite the downward pressure on the 5-year. This divergence, where one maturity drops while the others resist, is the physical proof of institutional accumulation. The smart money is catching the price. This precise technical trigger transforms a mere seasonal observation into a calculated, highly evidence-based entry point for a significant market move. We can see this exact mechanic play out in the historical record, specifically in the setups from 2008 and 2010. In June of those years, the 5-year bond pushed to a new low, while the longer-term bonds held firm, triggering the SMT divergence precisely within the seasonal window. Once this footprint was confirmed, the objective was to execute a buy order at the discounted price and wait for the multi-month trend to unfold. Executing this strategy requires ignoring the daily market noise and waiting exclusively for these precise technical and temporal conditions to align. The outcome of the 2008 setup was a massive, sustained rally that continued all the way into September and October. That single trade, held with patience, generated between $12,000 and $28,000 in profit per contract. This is why it is considered a mega trade. However, look at 2012 and 2013. These were dud years where the expected seasonal low and the technical divergence simply failed to materialize. When the criteria are missing, the disciplined trader takes no action. This protects capital from the losses that come with chasing a setup that isn't there. A professional strategy is defined just as much by the losing trades it prevents as it is by the massive profits it captures. The bond market is not an arena for frantic activity. It is a space for absolute, calculated stillness. The formula remains consistent. Wait for the May-June window, verify the SMT divergence footprint, and follow the autumn trend. This alignment of time and technical signals provides a statistical edge. transforming the individual trader into a shadow of institutional intent. Success in this arena is a product of the discipline to remain inactive for months, waiting to flawlessly execute one perfect mega trade.